Imagine spending decades building your retirement savings only to watch it shrink due to poor investment choices. That's the fear many retirees face. When you're no longer earning a regular paycheck, protecting what you've saved becomes your number one priority. I thought I was being smart by keeping everything in CDs, my neighbor Frank told me last week. But after 5 years, inflation had eaten away so much of my purchasing power that I couldn't afford the same lifestyle anymore. Frank's story isn't unusual. The challenge in retirement isn't just preserving your capital, it's balancing safety with enough growth to outpace inflation. If you're retired or nearing retirement, protecting your savings is more critical than ever. The financial landscape is unpredictable. Market downturns, inflation, and rising living costs can quickly erode a lifetime of hard-earned savings. But how do you ensure financial stability while still generating income in retirement? In this report, we're breaking down the safest investment options available to retirees, helping you protect your nest egg while securing a comfortable future. Now let's explore specific low-risk investment options that form the foundation of a secure retirement portfolio. We'll start with perhaps the most straightforward, high-yield savings accounts and certificates of deposit, or CDs. These vehicles offer something increasingly precious to retirees: certainty. With FDIC insurance protecting up to $250,000 per depositor per bank, these accounts provide virtually risk-free storage for your short-term funds. While returns have historically been modest, today's higher interest rate environment has made these options increasingly attractive, with some online banks offering rates above 4%. Consider Marcus by Goldman Sachs or Ally Bank, which consistently offer competitive rates without monthly fees. These accounts should serve as your first line of financial defense, perfect for emergency funds and covering near-term expenses. For slightly higher returns, CDs lock in your rate for periods ranging from 3 months to 5 years, though at the cost of reduced liquidity. Consider this approach. Instead of putting $50,000 in one CD, create a CD ladder. Put $10,000 each in 3-month, 6-month, 1-year, 2-year, and 5-year CDs. As each matures, reinvest in a new 5-year CD to maintain the ladder. According to FDIC data, this strategy typically yields 0.5 to 1% more than keeping everything in short-term CDs. Treasury securities, including bonds, TIPS, and I-bonds, are another cornerstone of safe retirement investing. Moving beyond basic cash equivalents, Treasury securities represent the next tier of safety for retirees. TIPS, or Treasury Inflation-Protected Securities, and I-bonds are particularly attractive as they provide protection against inflation. With inflation rates fluctuating, having investments that keep pace with rising costs ensures your purchasing power remains intact. This is crucial when planning for a retirement that could span decades. Imagine the security of knowing your purchasing power is safeguarded against the rising costs of goods and services. Treasury bonds provide fixed interest payments for terms of 20 to 30 years, offering predictable income with virtually no default risk. For those concerned about inflation, and every retiree should be, Treasury Inflation-Protected Securities, or TIPS, adjust their principal value based on changes in the Consumer Price Index, helping preserve your purchasing power over time. Perhaps most compelling for today's retirees are Series 1 savings bonds, commonly called I-bonds. These unique securities combine a fixed rate with an inflation adjustment that changes every 6 months. During recent inflation spikes, I-bonds delivered returns exceeding 9%, far outpacing traditional savings vehicles. While purchase limits apply, currently $10,000 per person annually through Treasury Direct, married couples can effectively double this limit. Here's a simple strategy. Create a TIPS ladder by buying bonds with different maturity dates. This gives you regular access to your money while maintaining inflation protection. For retirees seeking guaranteed lifetime income, fixed annuities present another conservative option worth considering. Think of these insurance products as creating your own personal pension. You provide a lump sum to an insurance company, and in return, they guarantee regular payments for a specified period or for life, regardless of market conditions. Fixed annuities offer a guaranteed interest rate, while indexed annuities provide returns tied to market indexes, with downside protection. Fixed annuities provide a guaranteed lifetime income stream, making them attractive for retirees seeking predictable monthly payments. However, it's essential to consider the fees and terms before purchasing, as annuities are not liquid investments. A 70-year-old man could currently purchase a $100,000 immediate annuity and receive about $645 monthly for life, according to immediate annuity calculators from major providers. When considering annuities, be mindful of fees. The average variable annuity charges 2.3% annually according to Morningstar, which can significantly reduce returns. Before purchasing any annuity, consult with a fiduciary financial advisor who can help you navigate complex contracts and identify hidden costs. For many retirees, allocating only a portion of their portfolio to annuities, enough to cover essential expenses not already covered by Social Security, represents a prudent approach. The peace of mind this provides cannot be overstated. However, these products come with important caveats that demand careful scrutiny. Fees can be substantial. Surrender charges may apply for early withdrawals, and the financial strength of the issuing insurance company matters tremendously. Remember, these guarantees are only as solid as the company backing them. For those willing to accept moderate risk, dividend-paying stocks from large established companies can offer stability with consistent payouts. These stocks provide a balance between growth and income, making them suitable for conservative investors, too. Now, while preservation is critical in retirement, modest growth remains necessary to combat inflation. This is where dividend-paying blue-chip stocks enter the picture. Companies with decades-long histories of not just paying, but increasing their dividends provide a compelling combination of income and growth potential. Companies that have increased their dividends for 25-plus consecutive years are called dividend aristocrats. Consider companies like Johnson & Johnson, which has increased its dividend for 61 consecutive years, or Procter & Gamble, with 67 years of dividend growth. These corporate giants tend to weather economic storms better than most, continuing to deliver income even during market downturns. A $100,000 investment in dividend aristocrats in 2000 would be worth approximately $560,000 today, compared to $320,000 for the S&P 500, according to data from S&P Dow Jones Indices. Preferred stocks blend characteristics of bonds and stocks, typically offering higher yields than common stocks or corporate bonds. I put about 10% of my portfolio in preferred stocks, retired teacher Ellen mentioned. The 5 to 6% dividend yield helps cover my property taxes each year. For retirees uncomfortable selecting individual stocks, dividend-focused ETFs like the Vanguard High Dividend Yield ETF offer instant diversification across hundreds of dividend payers. The iShares Preferred and Income Securities ETF, PFF, offers broad exposure with a yield that's historically been 2 to 3% higher than 10-year Treasury bonds. While any stock investment carries some risk, these stable companies typically exhibit less volatility than the broader market, while providing income that often grows faster than inflation. Real estate investment trusts, REITs, own income-producing real estate and must distribute 90% of taxable income to shareholders. Similarly, utility companies provide essential services with regulated returns, resulting in stable dividends. According to Nareit, equity REITs have delivered average annual total returns of 9.6% over the past 20 years. Utilities have historically provided lower returns, around 7 to 8%, but with less volatility. Bonds remain a staple of retirement portfolios. Bond funds and municipal bonds offer lower risk compared to stocks, providing reliable income streams. Municipal bonds add another dimension: tax advantages. The interest from these state and local government-issued securities is typically exempt from federal income tax, and if issued in your state of residence, state taxes as well. For retirees in higher tax brackets, this tax-equivalent yield can be substantial. A retiree in the 24% federal tax bracket receiving a 4% yield from municipal bonds would need to earn 5.26% from taxable investments to achieve the same after-tax return. This tax efficiency makes munis particularly valuable in taxable accounts, helping stretch your retirement dollars further. for fixed income exposure with greater diversification than individual bonds. Bond funds and municipal bonds deserve consideration. Bond funds, which diversify holdings across multiple bonds, also reduce risk while maintaining steady income. Investment-grade corporate bonds and municipal bonds offer slightly higher yields than treasuries while maintaining relatively low risk. Investment-grade bond funds spread risk across hundreds of corporate or government bonds, reducing the impact of any single default. While they don't offer high returns, their reliability makes them a strong addition to a retirement portfolio. No single investment is foolproof. Beyond selecting individual investments, proper diversification remains your strongest defense against financial uncertainty in retirement. By mixing low-risk investments, you create a stable and resilient portfolio. Asset allocation, or how you distribute your investments, plays a critical role in retirement planning. A balanced portfolio may include a mix of safe investments, such as bonds and annuities, with moderate exposure to stocks. A common strategy is the 60-40 portfolio, which allocates 60% of assets to stocks and 40% to bonds. For most retirees, the traditional guideline was to subtract your age from 100 to determine your stock percentage. Today, with longer lifespans, many advisors suggest subtracting from 110 or 120 instead. However, as retirees age, this ratio often shifts to favor bonds, prioritizing stability over growth. Market movements will change your asset allocation over time. Regular rebalancing helps maintain your risk level. A study in the Journal of Financial Planning found that annual rebalancing improved risk-adjusted returns by approximately 0.5% annually compared to never rebalancing. Many financial advisors now recommend a bucket strategy, dividing your portfolio into 3 distinct time horizons. Consider dividing your investments into 3 buckets. The first bucket contains highly liquid cash equivalents for immediate needs, 1 to 2 years. The second holds primarily fixed income investments for intermediate needs, 3 to 10 years. The third bucket, for longer-term growth, contains a carefully selected mix of dividend stocks and other growth investments. This approach allows you to remain calm during market volatility, knowing your immediate needs are covered regardless of market conditions. It provides both psychological comfort and practical financial security. While safe investments are essential, knowing what to avoid is just as important. The siren call of high returns can be particularly dangerous during this vulnerable financial period. Speculative investments like cryptocurrency, unproven startups, or the latest market fad have no place in a retirement portfolio. Also, be wary of high-fee investment products. These fees can erode your returns over time, significantly impacting your long-term financial health. Protect your hard-earned money from unnecessary expenses. Be particularly wary of anyone promising guaranteed high returns with no risk, the classic hallmark of investment fraud. Sadly, retirees are disproportionately targeted by financial scams, with estimated annual losses exceeding $3 billion. Remember Warren Buffett's first rule of investing: never lose money. His second rule: never forget rule number 1. This wisdom is especially applicable in retirement. Protecting against inflation and market downturns requires special attention for retirees. Inflation can quietly erode retirement savings, making it essential to have inflation-proof investments, such as TIPS and I-bonds. Additionally, retirees should adopt smart withdrawal strategies to avoid depleting savings too quickly. The widely cited 4% rule, withdrawing 4% of your initial portfolio in your first year of retirement and adjusting that amount annually for inflation, provides a starting framework, though individual circumstances may require personalization. Consider implementing a dynamic withdrawal strategy that adjusts based on market performance. Taking slightly less during down markets can dramatically improve your portfolio's longevity. Some financial experts suggest reducing withdrawals by 10% after years when your portfolio loses value, helping preserve capital during critical periods. However, the bucket strategy, which divides your savings into different buckets for short, medium, and long-term needs, can provide greater flexibility and security. Think of it as having different reserves for different stages of retirement. Investing in retirement can be complex, making professional financial guidance invaluable. Working with a qualified financial advisor, specifically a fiduciary obligated to put your interests first, can help customize these strategies to your specific needs, risk tolerance, and goals. Look for advisors with credentials like Certified Financial Planner, CFP, or Chartered Financial Analyst, CFA, and always verify their background through resources like the SEC's Investment Advisor Public Disclosure website. The right advisor becomes an invaluable partner in navigating the complex financial landscape of retirement. A trusted financial advisor can help tailor an investment strategy to your specific needs. However, retirees must be cautious of financial scams. Fraudsters often target older adults with fake investment opportunities. Always verify credentials and be skeptical of too good to be true offers. Let's recap the safest investment strategies for retirees. Prioritize capital preservation and steady income. Consider high-yield savings accounts, CDs, and Treasury securities for stability. Explore fixed annuities for guaranteed income. Invest in blue-chip dividend stocks and municipal bonds for reliable returns. Avoid high-risk investments and financial scams. Use diversification to protect your savings from market volatility. By implementing these strategies, you can safeguard your nest egg while maintaining financial security in retirement. What's your biggest concern when it comes to retirement investing? Let us know in the comments below. And if you found this information helpful, don't forget to like, subscribe, and hit the notification bell for more expert insights on retirement planning. Stay informed, stay secure, and we'll see you next time on the Retirement Report.